This is Nightly Business Report with Tyler Matheson and Sue Herrera.
iPhone slump snapped. Sales of Apple's flagship product rose after 3 quarters of declines, but are investors still waiting for a new breakthrough product?
The right prescription? President Trump calls drug companies to the White House and pledges fewer regulations and lower taxes.
Long runway. Airports are overcrowded and inefficient. But now one city is building a brand new one, and it's not waiting for money from Washington. Those stories and more tonight on Nightly Business Report for Tuesday, January 31st.
Good evening, everyone, and welcome. This is the heart of earnings season, and tonight the most valuable company in the world, and one you likely own in a fund, a 401k, or outright, reported a strong quarter. Apple beat both on earnings and sales estimates, and perhaps more importantly, it reported a rise in iPhone sales after 3 straight quarters of declines. And it cited strong demand for the newest version of its most popular product, the iPhone 7. Apple earned $3.36 a share. That was a full 15 cents better than Wall Street forecasts. Overall revenue up 3% to a record $78 billion in just 3 months' time. And investors liked what they saw, sending shares initially higher in after-hours trading. Josh Lipton has more on Apple's results.
$78.3 million. That was the big number in Apple's latest quarterly report. It was first to the number of iPhone units in the quarter, and that was better than expected. The street had been at $77.4 million. Of course, for all the talk of Apple Pay, Apple Music, the iPhone does remain Apple's flagship product, accounting for the bulk of its revenue. I did have the chance to speak briefly with Apple CEO Tim Cook. He said it was a dynamite quarter for the iPhone. He pointed out strength specifically in the U.S., Japan, and Western Europe, as well as emerging markets like Turkey, Brazil, and Russia. As for looking ahead, I asked Cook why the optimism for the iPhone in the quarters ahead. He said he had confidence in their current product lineup. He pointed to strength in new areas like India, where Apple does have relatively low penetration. Still, Apple hit an all-time record total revenue in India for the quarter. And of course, about that pipeline, Cook saying, we are very excited about our pipeline. I did ask him, certain skeptics, of course, point out perhaps any changes that are coming to the iPhone in the fall will necessarily be evolutionary in nature. He said, well, they don't work here. For Nightly Business Report, I'm Josh Lipton, Cupertino, California.
Let's turn now to Tim Lesko for more reaction to Apple's earnings results and what he sees ahead for the company. He is Principal Portfolio Manager at Granite Investment Advisors. Tim, welcome. Nice to have you here.
Nice to be here. It
was almost like Apple saying, you know, take that. The iPhone is doing well. What did you think of the report?
Well, I thought it was a good report. You had a beat on earnings, you had a beat on revenue, you had a beat on iPhone numbers. Certainly, the forward-looking guidance was conservative, as Apple tends to be. I'm not sure that Apple thinks as quarter to quarter as investors do or as the public does. So Apple, maps out their products years in advance and has a plan. And in many ways, they can't divulge exactly what that plan is. But I guess they're probably resting easier in Cupertino tonight. But, it was a really nice number.
What's next for them?
Well, I think the iPhone has shown that looking forward, you have software as a service. So rather than necessarily needing a device, you're going to have, whether it be a wearable, whether it be your phone, or whether it be something else, that essentially tells whatever device you're near that you're near it, and it's going to deliver your services. And Apple's really been building that ecosphere for a long time with iPhone, and it bleeds over into the watch. And it will bleed over into the HomeKit, where you're going to have internet-connected devices that are going to be running on Apple software. You're going to bleed over into the car, where you're going to have Apple's CarPlay software organizing your digital life for you. So I think the ecosphere has, a long way to go, long past maybe the evolution of the iPhone.
Tim, you said something interesting a moment ago. You said Apple has a plan. It doesn't look at the timeline basically the way some investors look at the timeline. But isn't that an appropriate way to run a company, especially a technology company?
Well, absolutely. And the advances in technology need to come along with the advances in thought and technology. you could have a plan for what you want to do in technology in 5 years, but you also need to know what kind of hardware is going to be available to do that. And that's why they have these long-term roadmaps. And I think that Apple has done a really nice job. They're very good stewards of investors' capital. They're net, they have a net cash balance larger than most companies. And they've been investing for the future. So as a management of a company, we think they've done extraordinarily well.
On that note, Tim, thank you very much. Tim Lesko with Granite Investment Advisors.
Well, Apple's numbers were quite nice, but so far earnings have not been able, as an aggregate, to provide investors with clarity on the strength of the economy. Now, that seems to have stalled the stock market rally, along with concern that the political drama out of Washington may be overshadowing the push for pro-growth policies. Today, the Dow closed down triple digits for the second consecutive day, off 107, almost 107 points to 19,864. NASDAQ up by a little bit, about 1 point, and the S&P 500 dropped for a fourth consecutive session. For the month of January, there you look, the three indexes of them, the NASDAQ rose the most, up about 4%.
Dow component ExxonMobil saw its profits fall nearly 40%, though the results would have been better if a $2 billion impairment charge was excluded. Persistently low oil prices and weak profit margins in Exxon's refining business pulled down earnings for the full year. Revenue, however, was higher, but that wasn't enough to lift the shares, which fell in trading today.
Pfizer reported disappointing quarterly profits. The drug maker cited lower demand for its flagship vaccine and higher expenses. The company also issued a downbeat sales outlook and said it expects to lose billions in revenue as some of its drugs lose exclusive sales rights. But there was a bright spot. The revenue for the most recent quarter was better than expected.
While the CEO of Pfizer was on his company's analyst call, his peers were at the White House meeting with President Trump. The president called on them to manufacture more of their drugs in the U.S., while also vowing to cut taxes and roll back regulations. That helped lift stocks in the sector, with Dow components Pfizer and Merck finishing higher on the day. Meg Terrell reports.
He said the pharmaceutical industry is getting away with murder and pledged to bring drug prices down. But today, President Donald Trump struck a gentler tone with the pharmaceutical industry as leaders of some of its biggest companies were summoned to the White House.
You folks have done a terrific job over the years, but we have to get prices down for a lot of reasons. We have no choice. For Medicare, for Medicaid, we have to get the prices way down.
Drug prices were still topic number one, but the president also pledged to reduce regulations, improve U.S. taxes, and accelerate drug approvals at the FDA.
We're going to streamline the FDA, and you're going to get your products either approved or not approved, but it's going to be a quick process. It's not going to take 15 years.
In return, many pharma CEOs emphasized their commitment to the U.S., from California drug maker Amgen to pharma giant Merck.
We're confident about the outlook for innovation in this country, and proud to say we'll be adding 1,600 jobs at Amgen this year.
We're bringing manufacturing back for our cancer drug. You may have heard that we have an immuno-oncology drug that stimulates the immune system to kill different cancers. We're bringing those jobs here, Mr. President.
That's very good.
Shares of drug companies rose after the meeting as industry watchers perceived Trump to have stepped back his once aggressive stance on drug pricing.
I think we've seen a pattern where President Trump talks very tough in public, but then when he gets in private with these business leaders, likes to make nice. He's a deal maker. And so, I think what you heard today was a softening of his position on drug prices, a real willingness to give the industry tax breaks and to help them with regulatory issues. So I'm not really sure this is an industry he's trying to change.
Trump did focus on the Food and Drug Administration, saying he has a, quote, fantastic person he'll be naming very soon to streamline the industry. Many in the drug industry, though, have already praised the FDA for accelerating the drug approval process, leading some to wonder if the new administration will strike the right balance between proving a drug works and is safe and speeding its path to market. For Nightly Business Report, I'm Meg Terrell.
In addition to naming someone to head the FDA, the president is also scheduled tonight to announce his nominee for the Supreme Court. It's widely expected to be one of two federal appeals court judges, Neil Gorsuch of Colorado or Thomas Hardiman of Pennsylvania. Gorsuch's judicial philosophy is considered similar to Antonin Scalia's. Hardiman is considered a law and order judge.
Well, the news out of Washington just keeps coming, but has it all been too much, too fast for the stock market? Mark Lehman, president of JMP Securities, joins us now to discuss. Mr. Lehman, welcome. Good to have you with us. Let me ask by twisting the question just a little bit, and I wonder whether this is something that has the market a little perplexed. Can an administration be pro-business, avowedly so, aggressively so on the one hand, and also pro-protectionism on the other at the same time?
You know, that's a great question, and it's one I think investors are going to have to wrestle with. This is all new territory for both the president and for a stock market to see that kind of dynamic play together. I think it's if you start really the specter of a protectionist president, I think it's very, very difficult to see stocks making new highs because this is uncharted territory. We haven't had a trade war in a while. There's definitely that specter out there. The pro-business side, I think, has got people excited. The less regulatory overhang and some of the other things that President Trump has talked about, obviously the market likes. The more you talk about a protectionist environment with the kind of trade partners we have, the more it's uncharted territory. And before we find out those facts, people generally sell and ask questions, and then they decide to buy later, not right away.
We have seen him do some executive orders on regulations, but are you one who thinks that he should be talking more from the market standpoint anyway about tax reform and things like that instead of perhaps the immigration side of things?
I think the market certainly appreciates what President Trump stands for as it relates to the protectionist side, as it relates to the regulatory side. I think we know that. On the immigration side, I think the kind of speed with which those orders came out, the timing of what they came out, and then the other text that came out over the weekend about who knew what when is just not what the market's used to and is not what investors are used to. Frankly, I think some of the reaction of the market has been muted. To be down as little as we are over the last couple days in the face of the kind of rally we had and the kind of news we had, I think it's quite impressive. So the market, I think, is giving the president the benefit of the doubt. We see more of these executive orders and more of this kind of what I like to call kind of ready, fire, aim politics. The more the market's going to be a little bit less, I think, is more susceptible to kind of downdrafts that we saw the last couple days.
So it seems like what you're saying here, it may not be the speed so much as it is the nature of the presentation, and that things have not rolled out as smoothly, and they've caused an uproar in some areas.
I think they have. I mean, listen, we watched over the weekend as the kind of rallies and the rallying cry that we saw over the weekend. Everybody was either watching their Twitter or watching their Facebook feed, which is probably good for those stocks, but probably was keeping people over the weekend in a place that they're not used to, which is seeing actions on Friday night and watching their news feed over the weekend. I think you're going to see that temper a little bit. I think there's probably an uproar behind closed doors, and whether the president decides to listen to that kind of uproar is a question to be seen. But I think the odds are we're not going to be seeing as many of those because this was a backlash that we just frankly haven't seen in a very long time.
Yeah. All right, Mark, thank you very much. Mark Lehman of JMP Securities.
The Federal Reserve today began its two-day meeting on interest rate policy. And while a rate increase is unlikely to be announced tomorrow, policymakers will be discussing their outlook for the economy. And according to a new survey, there's one thing that economists and money managers see as a threat to the recovery. Steve Leisman has more.
The CNBC Fed survey for January finds that there's a lot of support for the new policies of the Trump administration, but one huge concern. Take a look here. Individual tax cuts supported by 75%. Business tax cuts by 80% or more. And then deregulation is the favorite of the 41 respondents to our survey. They include economists, fund managers, and strategists. But more than 80% here have a negative view on Donald Trump's trade policies, and that overshadows a lot of the good stuff that they expect. And that may be a reason why the idea of what's behind the recent market rallies come down a little bit. Back in our December survey, 82% ascribed the market rally to policy expectations from the administration. That's down to 72%. And those who say it's really economic fundamentals, that's up to 26%. It's also a reason why these economists and fund managers think the market overall is too optimistic, 56% saying that about expectations for policies from the Trump administration. 39% say they are realistic. And then again, when we look at the biggest threats, take a look at some of the history of this series of questions we've asked. Back in April 2012, 37% thought the European financial crisis was the biggest threat. 41% thought the fiscal cliff in July 2012. Global economic weakness, remember early last year, sent the markets into a swoon. 44% said that was the biggest threat to the economy. And now 51%, the first time we've had a majority focus on a single threat to the expansion here in the history of this survey. 51% saying now protectionism is the biggest threat. For Nightly Business Report, I'm Steve Leisman.
And by the way, nearly all of the respondents in the survey say the Fed will keep interest rates on hold when it releases its policy statement tomorrow. Economists, strategists, and money managers predict 3 rate increases this year, with the next move likely to come at the June meeting.
Still ahead, shares of Under Armour plunge. Is the growth story over for this one-time Wall Street darling? Under Armour, once a dominant player in athletic retail, is stumbling. The company is seeing its profits erode, sales slide, and it says things may not improve anytime soon. Add to those growth concerns and the departure of its chief financial officer, and you have a stock that lost 25% in trading today. Lots of alarm bells are ringing when it comes to Under Armour, as slowing growth pushes it further behind the global giants it wants to compete with, like Nike and Adidas. Under Armour's sales grew by 12% last quarter, the first time it reported sales growth under 20% in more than 6 years. This year, Under Armour cut its sales forecast by more than $500 million to $5.4 billion. The stock is now down more than 50% in a year. The culprit? Steep price cuts, according to CEO Kevin Plank.
Slower traffic caused significant promotional activities, earlier, deeper, and broader than expected. This commoditized some of our more basic core product that had previously sold through for us in years past. This, in addition to higher demand for more lifestyle silhouettes, caused us to be out of balance with our assortment.
Lifestyle hasn't been adding life to Under Armour's numbers. The company's been investing in lifestyle offerings and performance measuring gear, think Fitbit, but those sales have lagged. The company gambled big on lifestyle, hoping to attract millennial buyers by spending on sponsorships with the likes of Tom Brady and Steph Curry to create its own sportswear brand, a big payout that has yet to pay off. There's also the troubling overall retail picture. With companies like Sports Authority declaring bankruptcy, Under Armour has fewer places to sell its products. And Under Armour announced its CFO, Chip Malloy, will be leaving at the end of the week, after only a year on the job. Senior VP David Bergman will step up as acting CFO, with the company looking to re-accelerate in a choppy retail market. Under Armour isn't only competing with companies like Nike and Adidas. Kohl's, The Gap, and even luxury brand Chanel are now selling their own lifestyle apparel brands.
Well, it would seem like a slam dunk as more people order goods online. Delivery companies should benefit, right? Well, that's not what happened at UPS. In the latest quarter, the world's largest package delivery company reported earnings and revenue that missed expectations. It issued weak guidance about the future, and that pressured shares today, as you see right there. So why didn't UPS get a big lift from the surge in online shopping? Morgan Brennan explains.
Packages may have made it in time for Christmas, but UPS failed to deliver for investors. The big culprit, the gangbusters growth of e-commerce.
We actually had a good fourth quarter, but what we saw was a tremendous shift in the amount of volume that went to the consumer versus to the business. In fact, we looked over the last 10 years, and this is the fastest rate of change. So while volume continued to grow, opportunity continues to grow because of the B2C, or business to consumer, we saw the impact.
As consumers turn to the internet to buy more and more goods, delivery companies are scrambling to keep up. During the holiday season, UPS moved a staggering 712 million packages, 16% more than in 2015, with nearly 2/3 headed to homes, including 2.5 million new addresses. Higher volumes meant more strain on the network and more pressure on margins. It's much costlier to deliver individual packages to individual doorsteps rather than to one location with business shipments. As e-commerce surges, UPS is doubling down with plans to spend $4 billion a third more than last year, to automate facilities and expand capacity. It's also raising prices. But while it's accelerated, this trend has played out in UPS's earnings before. One reason Avondale Partners' Donald Broughton rates the stock a hold.
This company either takes advantage of the e-commerce market and gets tons of volume and then is unable to get things delivered on time. Then it says, well, we're not going to let that happen again. We're going to spend money on infrastructure. We're going to spend money on technology, people. And the following year, it gets things delivered on time, but it spends so much money, it doesn't result in incremental margins. This year, no service issues, but no margin either.
UPS was also impacted by weak industrial production and a strong dollar. The company expects better economic growth in the U.S. this year, and management says it, quote, looks forward to working with the Trump administration as tax reform, infrastructure spending, and new bilateral trade agreements are potentially rolled out. For Nightly Business Report, I'm Morgan Brennan.
Higher premiums help Aetna top earnings expectations, and that's where we begin tonight's Market Focus. The health insurer said lower than expected medical costs also helped overall. Profit was hurt, though, by higher restructuring costs. And after a federal judge blocked the company's proposed $34 billion takeover of Humana last week, Aetna says it isn't giving up just yet.
I think one of the things that we need to consider, and we have until February 15th to make this decision, that's when our merger agreement ends, is what are the various options we could pursue to try and get this combination done. We believe this combination would provide a better product for seniors, a better product for the Medicaid population, more affordable and simpler.
Aetna shares were up more than 1% to 118.61. Eli Lilly said strong demand for its diabetes drugs led to higher revenue in its latest quarter. The pharmaceutical company also saw profit rise, and it reaffirmed its full-year earnings guidance. Shares of Lilly were up 3% to 77.03. Sprint's subscriber growth topped expectations and beat rivals Verizon and AT&T. It was the most subscribers Sprint has had in 4 years. On the earnings front, the wireless company also posted a narrower net loss, but it was still wider than expected. But Wall Street focused on the subscriber growth and sent shares up 12 cents to $9.23.
MasterCard posted a better than expected profit as an increase in customer spending during the holidays lifted results, but the company did miss revenue targets, citing a stronger dollar and more rebates. MasterCard also warned the dollar would hurt revenue growth and net profit this year. That sent shares nearly 3% lower at 106.33. The handbag maker Coach also said the strong dollar would cause revenue growth to slow this year. The company saw its quarterly profit beat expectations thanks to strong demand for its pricier 1941 collection and strong overseas sales. Coach's same-store sales also beat estimates. Shares were up nearly 4% at 37.35. And coming up, fixing our nation's airports.
I'm Phil LeBeau in Salt Lake City, Utah, where they're building a brand new airport. Why aren't more cities doing this? That story coming up on Nightly Business Report.
San Francisco has become the first city to challenge President Trump's executive order over sanctuary cities. The order directs the federal government to withhold money from cities that do not cooperate with immigration officials. If San Francisco does not comply, it could lose more than $1 billion. The lawsuit calls the order unconstitutional.
One reason for the recent optimism on Wall Street is the expectations that billions of dollars will ultimately be spent on fixing America's aging infrastructure. That includes dozens of airports that are overcrowded, inefficient, and in need of being either renovated or replaced. In Salt Lake City, they're already building a new one. Phil LeBeau takes a look at the long runway from approving a new airport to getting it up in the air.
Fly into Salt Lake City and you'll find an airport that looks far better than others in America. But underneath, it is straining, handling twice as many passengers as it was designed for when it was built in 1961. So right next to old terminals, Salt Lake is building an all-new airport. The cost? $2.9 billion.
There's the planning process, there's an environmental process you have to go through, there's a procurement process you have to go through, and then there's the actual construction process you have to go through. And in many cases, airports particularly, you end up building on the same footprint you're occupying. So oftentimes you're trying to remodel the kitchen while you're trying to cook Thanksgiving dinner.
Phase 1 of Salt Lake's new airport won't be done until 2020. When it's completely finished in 2023, even more people will fly into Utah's capital. Fact is, the number of people flying in the U.S. keeps soaring. There are more flights, more congestion, and more talk that fixing America's airports will have to include alleviating traffic jams on the tarmac.
There's a huge amount of money that's needed to invest in airport terminals, but also on the runways. We need more runways because a great terminal isn't great if you can't land or take off.
It's estimated fixing all of America's airports could cost up to $75 billion, more money than what Congress is likely to authorize. So airlines like Delta are stepping up. It's investing in new terminals, including at its hub here in Salt Lake City.
Security, gate boarding, check-in will all be completely revamped and offered in a way that reduces stress, reduces variability, and creates a more service-oriented and less stressful experience.
An investment in the future of travel as more Americans than ever take to the sky. Phil LeBeau, Nightly Business Report, Salt Lake City.
And that's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Matheson. Have a great evening, everybody, and we will see you right back here tomorrow night.